And it's a matter of, I've told everybody about the don't fuck this up thesis of how to deal with volatility, how not to lose control of your tokens, because this stuff compounds over time. Bitcoin since 2012, 27.5 million % returns. Again, nothing ever has remotely come close to this. So that's the opportunity. And we said the tech stocks, they're great, and Bitcoin or crypto is great. Fantastic.
Bitcoin, a cryptocurrency, is once again making headlines in the financial world, and it is getting close to the psychologically and technically important $10,000 level very quickly. The price went up from $97,759 to $99,140 because of the geopolitical shock caused by former President Donald Trump's announcement of a trade deal between the US and UK. Participants in the market saw this as a sign that growth was possible, which made people optimistic about cryptocurrencies in general. Analysts like Charlie Sherry of BTC Markets have noticed the quiet change in Bitcoin's price action as it defied bearish expectations and changed its short-term market outlook. This happened because Bitcoin didn't do what bears thought it would. Neil Jacobs, co-founder of Evmo21, and Anthony Pompliano, a macro investor, both said that the announcement was a big reason why the price went up. It was said by both of these people that the announcement is a sign of a larger macro realignment that could lead to record highs by 2025. As political unpredictability rises and economic nationalism rises again, Bitcoin is seen as a macro hedge more and more. This story seems to be resulting in real capital flows, as shown by the fact that $96 million worth of short positions were closed in just 24 hours.
So they forced into more speculative, high-risk assets that have much higher returns. It's the only way out of the trap. And the trap is driven by this debasement. So if you want to see how close the correlation is, and I'll show the full correlation chart later, it basically drives Bitcoin. And what we see is there's periods where it decouples, and these are the banana zones. It decouples when what we get is the retail frenzy and the frenzy into the market, cools off, comes back to trend rate of this debasement of 8% or so. But over time, it produces astonishing returns. And that's why Bitcoin looks like this on the log regression channel. It's also still remarkably cheap. Where it ends up at the end of the banana zone is usually the 1 or 2 standard deviation level. We're a long way from that, and that would give us much higher prices. You can't see it on this. But if it were to get to 2 standard deviations, that would put Bitcoin at $850,000. I don't think it's going to go there, but what we're saying is there's plenty of upside to come. I know people get frustrated in sideways markets. It's just the nature of the beast. It does nothing, corrects for a while, and then explodes out of the traps. And we're kind of in that phase now that I'll talk to you about. When we talk about debasement of currency, you can't see this very easily. But at the top here is, well, these are all of the asset classes that we monitor at Xpan, my asset management firm. And you can see that most of the returns of US small caps, REITs, treasuries, preferred stocks, high yield bonds, they're all annualizing at less than 10% a year returns. So owning those assets makes you actually poorer because of the debasement. Once you get to the S&P 500, you're at 12%. Basically, you break even. Divide the S&P 500 by global total liquidity, it's basically a flat line. So owning US equities in the broadest sense makes you no money either. So all of the millennials who've been piling money into 401ks are not getting richer. So none of their 401ks will buy them as much of a house and stuff like that. Only when you get to technology investing do you start beating the benchmark. And so this realization from the Everything Code is debasement of currency. There are only 2 assets that matter in the entire world. One is technology, and 2 is crypto. And crypto dwarfs everything else. It is the greatest performing asset in all recorded history. We've never had anything like this before. So here's Bitcoin since 2012, 130% annualized. That's including 3 gigantic drawdowns. Ethereum at 113 and Solana at 142. So, and Solana obviously starts later. So the magnitude of the returns is enormous. The volatility, we have to stomach to do it, is the game. And it's a matter of, I've told everybody about the don't fuck this up thesis of how to deal with volatility, how not to lose control of your tokens, because this stuff compounds over time. Bitcoin since 2012, 27.5 million % returns. Again, nothing ever has remotely come close to this. So that's the opportunity. And we said the tech stocks, they're great, and Bitcoin or crypto is great. Fantastic.
When the U.S. Federal Reserve decided to keep interest rates at 4.25% to 4.50%, Bitcoin was put to the test to see how strong it was. This choice was made at the same time that people were feeling good about trade. This move happened at a time when Donald Trump was criticizing the Federal Reserve for being slow to cut interest rates. As a result, there was a sell-off that sent the price of Bitcoin down to $95,866. The cryptocurrency asset, on the other hand, quickly recovered, and for the first time since February, it crossed back over the $98,000 mark. While inflation has slowed down, it is still above the central bank's target level of 2%, which Jerome Powell, chair of the Federal Reserve, reiterated. This means that interest rates should not be lowered just yet. At the same time, Powell acknowledged that the job market was still strong and that unemployment rates were getting close to all-time lows. On the other hand, political unrest and economic worries are having a big effect on how investors feel in general, especially when it comes to what global trade means. Because Bitcoin has quickly recovered in the face of tighter money, it looks like short-term Fed policy is having less of an effect on the cryptocurrency, at least in terms of sentiment. In this new era of digital money, this makes Bitcoin a stronger macro asset.
It also prices Bitcoin by doing this. And so when you look at Bitcoin itself, the moment the ISM, we've had this very low period of ISM, and that was driven by this very flat dollar, and also by rates staying higher than normal. But as the ISM starts crossing 50, economic growth comes back, earnings come back, household earnings come back, stuff gets reinvested in markets. So at this point is when Bitcoin super accelerates. And that point lies ahead. We're about to see that point now. Now, I haven't shown it on this presentation, but we've also imputed how it reacts to ISM. And if we get to that 57 ISM, that puts Bitcoin at 450,000. Is it exact? Will it be exactly that? No. But all of the people who are saying it's going to 150, 250 are probably scarred from last cycle without looking at the forward-looking data. So it's incredibly positive for me. It also is what drives altcoin season. So the fabled altcoin season, everyone's like, it's never going to happen again. It's just a function of the business cycle. Why? Because household earnings are still subdued, because the business cycle is subdued. Average businesses outside of technology have subdued earnings. The moment the business cycle picks up, everyone has spare cash. Cash gets recycled into assets. People move further out the risk curve. So altcoins are exactly the same as credit spreads, small caps, emerging markets, junk bonds, all of this. They're all exactly the same thing. The further out the risk curve, the business cycle actually drives all of it. It's also the same with fine wines. It's also the same with Rolex watches, all driven by the same thing. So we all want to see the ISM above 50. We've got the forward-looking data to say it's going to happen pretty soon, and that's going to be a very big signal to us. Usually that will happen as Bitcoin starts breaking all-time highs, which we imagine should happen pretty quickly, because that's every time that happens when we start to see these liquidity conditions. But the problem is nobody believes me. That's true. Everyone's like, no, but the markets and Trump and tariffs and geopolitics and China and then Russia and that's all and what you've all done is price in maximum fucking fear. At every point, you've got, this is number of stocks with a 40 days RSI below 30. This was before the rally really started. One of the few ever, this is the same as we had at COVID, when the world shut down. It's the same as the Russian default and the Asian crisis. People are crazy with fear. Investor intelligence survey, percentage bullish, all-time record lows. The least bullish people have ever been in history. And the forward-looking indicators tell you the economy is about to explode higher, and people are massive bearish. What was interesting is we just saw the charts coming out today was that retail investors had been buying the dip. Institutions still haven't. They're all massively underweight. There's another chart, sentiment, bulls versus bears, bearishness, again, all-time record highs, only ever been exceeded a couple of times in history. Consumer expectations for declines in stocks near all-time record highs. The VIX index, the measure of fear or volatility in the index, in the top 3 spikes of all time. And again, using my DMARC indicators, it's generally a reversal pattern. So quickly to go through the charts, this is the most important chart for you to understand, is that corrections are normal. You've just gone through a normal correction and you've managed to lose your minds, which is hilarious because we've had 7 of these. And last time around, they were bigger. Back in 2017, 28%, 39%, 38%, 27%. Nobody remembers any of those. In fact, none of you remember any of these. Some of you remember this summer because it was pretty miserable. But that one, do you remember that? Or that one? No. But each time you convince yourself it's never going to happen, it's all over, we're never going to make money. And in 2017, you did the same. And it just kept going up. Remember, 23x in that whole moment of you going, oh, it's all over, we're never going to make money. And me selling out somewhere here, thinking, yeah, I'm really smart. No, I was a moron. So again, using DMARC indicators, these have worked stunningly well because Bitcoin's now up here. These 13s, cluster 13s, lows. We had them in Solana as well. This chart is hilariously out of date. This was the hourly chart of SUI. When I said, listen, if it breaks this inverse head and shoulders on the hourly, it should be up. Well, now it's up somewhere above the top of this chart already. When I look at the chart pattern of SUI, it is a wedge pattern. Again, we're way up here. We're just short-term consolidating now. My guess goes to all-time highs pretty soon. It's a very bullish backdrop.
The Fear and Greed Index for cryptocurrencies has clearly moved toward greed, which shows that people in the market have changed their mindset from being cautious to being optimistic. This is because Bitcoin is trading very slowly in the upper $90,000 range. A big reason for this mood is that institutional capital keeps pouring into spot Bitcoin exchange-traded funds, ETFs. Since the end of March, these funds have received over $4.4 billion in new capital. This level of participation shows that cryptocurrency investments are becoming more established, and it also shows that more people see Bitcoin as a long-term asset. Even though the short-term outlook is still positive, some market observers are sounding a note of caution. If the Federal Reserve waits until late 2025 to make real rate cuts, liquidity may get tighter, which could put pressure on both traditional stocks and digital assets. In this case, Bitcoin could go back to the support area around $70,000 before it starts to rise again in a way that is sustainable. People are still painting a fundamentally bullish picture, even though political tailwinds, institutional participation, and rising scarcity are all still coming together. For now, the current momentum suggests that any dips may not be seen as weaknesses, but rather as entry points into a race that is getting more and more competitive for digital value.